Okay. Okay, so now we're going to go to the final part of the chapter. Okay, the last of the non-current asset, that is bond payable. Okay, so bond payable is a form of interest-bearing notes payable. Okay, normally it is issued by the government or any corporation that is financially stable. Okay, so the issuer is going to pay the face value, so the face value or the principal, and also the interest based on the contract given uh, before the maturity date or on the maturity date. Okay, so we go through the journal entry to record the issuance of bond at face value. Okay, so face value is actually the principal amount. Okay, so for bond, normally we're going to use bank, right? Because the amount of money that is issued for bonds payable is normally very large, a very huge sum of money. And since the amount is issued by the government or a very big financial corporation, so all the transactions are made into your bank account. So we are going to use only bank for bond. Okay, so when we issue the bonds payable, we will debit bank because we are receiving money from the issuance, and we will credit bond payable. Okay, so since the tenure of the bonds payable is for a longer period of time, so that means every year you are obligated to pay the interest. Okay, so the interest is paid uh, based on the contract mutually signed by the corporation. Okay, so we are going to pay the interest either twice a year or maybe once a year. Okay, depending on the information given in the question. So once you are making payments for the interest, so you will debit interest expense and you will credit bank. Okay, okay, so let's say um, the interest is for the current year, but no payment has been made yet. So still you need to record the adjustment for the interest expense. So as usual, we need to declare the interest expense for that particular year, but since no payment has been made yet, so we will credit our interest payable. Okay, and when we reach the maturity date, that means we need to record the redemption of the bond. Okay, so here during the maturity of the bond, we will debit bond payable. That means this is where you settle your tenure. Okay, and you will credit bank. So this is actually the face value that you are supposed to pay. Okay, what about the interest? Okay, interests are paid according to schedule. So sometimes during the maturity date, they won't be paying any interest expense. So that is why no interest expense is included in this redemption journal. Okay, all right. So we look at example given. Okay, example 10. Warisan Nusantara issued two types of bond. You have bond AA and also bond BB. Alright, bond BB, the face value is to 20 million. Alright, and the interest rate is 6%. Okay, so this is issued on 1st of May 2012, and the tenure is 10 years. Okay, and then the same company issued another bond with the amount of 5 million. Okay, and the one that is issued for bond BB, the interest rate is 8%. Okay, this is issued 2 months prior. Alright, 2 months after, that is on the 1st of July 2012, and the tenure is also for 10 years. Okay, so interest payment are made twice a year. So twice a year, that means every 6 months to bond holders. Alright, so Warisan Nusantara wants to redeem bond AA. by paying cash on maturity date. Okay, paying cash on maturity date, that means that will be crediting your bank account, right? Okay, so you look at bond AA. Okay, for bond AA, the date of the issuance is actually on 1st of May 2012. Okay, all right, so this is for bond AA. Okay, so the issuance date is 1st of May 2012, and after 6 months you need to pay for the first interest payment. All right, so May, June, July, August, September, October. All right, so that means 1st of May until 31st of May is 1 month. So May, June, July, August, September, October. So that means the first payment is due on 31st of October 2012. That is for bond AA. Alright, and you'll be doing the same thing for bond BB as well. Alright, to record the payments of interest. Okay, so we go through the journal entries to record the issuance of the bond. Okay, so here we are supposed to record the issuance for the bond. Okay, you have two types of bond AA and bond BB. The first bond was issued on the 1st of May. So on 1st of May 2012, you will debit bank and you will credit bond payable with the amount of 20 million. Alright, and then on the same year, on 1st of July, you will debit bank and you will also credit bond payable, but this is for a different bond, that is bond BB, with a face value of 5 million. Alright, this is how you go about with recording the issuance of the bond. So you have two different bonds, so the issuance is recorded in separate journals. After all, the issuance date is different, right? Okay, first one is issued on the 1st of May, and the second one is issued on 1st of July. Alright, and then we go through the next requirement of the question. You need to show the journal entry to the yearly interest payment for bond AA. Alright, so as I said earlier, the bond was issued on 1st of May 2012, so the first interest payment is due on October 31st. Alright, so October 21st is 6 months after the issuance of the bond, so you need to pay the interest on this day. So the amount that you need to pay is 6%, okay, from the face value, that is 20 million. But since you are paying for the first 6 months, so you need to multiply with 6 upon 12. So this is actually to record the first payment of the interest for bond AA. Alright, so now here we are actually doing for AA. Okay, and then next you need to record the payments of interest for the second bond, that is bond BB. So bond BB is issued on 1st of July 2012, so the first payment of the interest is due on 31st of December. So you will be doing the same thing. The face value is 5 million, multiply by 8%, and then because it is only 6 months of the interest expense, so you need to pay for 6 upon 12 only. So the amount of the interest for bond BB is due on the 31st of December with the amount of 200,000. Okay, so this is how you record the interest payment. So you, as you can see in the question, we are only paying the interest expense for the tenure, okay, along with the tenure. So that means if the tenure is 10 years, so you will be paying 10 years of interest, okay, twice a year. Every 6 months you'll be paying the interest expense, and when you reach the maturity date, then only you will be paying the face value. Okay, next we go through the redemption. Okay, redemption, that means that is actually your maturity date. Okay, when is the maturity date? Okay, the maturity date is on April 30th 2022. All right, okay, because it is a 10 years tenure, you issued the bond on 1st of May 2012. Okay, so for 10 years, that means you will redeem the bond on the year 2022. Okay, so you issued the bond on 2012. Okay, so 2012 to 2013 is 1 year. So 13 to 14 is 2 years. So 13, 14, 15, 16, 17, 18, 19, 20, 21, and 22. So that means your redemption year is the year 2022. Okay, since you issue the bond on 1st of May, so when you redeem the bond on the year 2022, the date will be 1 year, 1 day, sorry, 1 day early. So that falls on 30th of April. Okay, it's actually very easy. All right, so your redemption date is on the 30th of April, 2022. Okay, so how do we record the redemption journal on the redemption date? Okay, okay, so here I will debit interest expense. Okay, and then I will credit, I will also debit interest payable, and then I will be paying for the tenure, for the face value as well, that is 20 million. So the amount that I need to pay is actually 20,600,000. Okay, for those who are asking, where do I come across with the interest expense and interest payable during the redemption date? Okay, all right, this is how you go about with the journal. All right, okay, so I issued my bond. Okay, I issued the first bond. This is AE bond, right? Okay, the first bond was issued on 1st of May. Okay, this is the date of the issuance. Okay, so for your interest, you'll be paying every 6 months, right? Right, so the first date, the first payment earlier that we did in the journal entry is due on 31st of October every year. Okay, so I will be making the payments every 6 months. Okay, so my next payment will be on 30th of April the next year, correct? Okay, so I'll give you the year for you to understand more. Okay. Okay. Okay, so how do we actually calculate the interest expense? It's actually very easy. Okay, so let's see, I'm doing for 2012, right? Okay, I'm doing for 2012. Okay, this is for bond AA. Okay, the bond was issued on 1st of May 2012. Okay, so the interest is due, the first interest is due on 31st of October 2012. Okay, this is the first 6 months, and then the next 6 months is actually due on 30th of April, but that is for the year 2013. Okay, this is the second interest payment for the bond. Okay, every 6 months. Okay, as you can see here, this is for the year 2012, but this one is already 2013. It has exceeded the accounting period. Okay, so I'll draw you a timeline. Okay, so let's say you issue the bond here on 1st of May. So this is when you issue the bond. Okay, the first payment of the interest is after 6 months. Alright, so that means after 6 months, okay, you pay for the first interest. This is on the 31st of October 2012. Okay, and then you have another 6 months, okay, to pay for the interest. Alright, so let's say here is actually 30th of April 2013. Okay, but you must remember, okay, here is the closing date for the accounting period. Okay, that means this is the 31st of December. So as we all know, every 31st of December you need to do adjustment entries for all the expenses, including the interest expense from 1st of November until 31st of December. Okay, so that means these 2 months of interest expense is yet to be declared on the year of 2012, because that is what we are supposed to do, the adjusting entries. So these 2 months is actually your interest payable. Okay, this is 2 months of it. Alright, so your interest expense earlier was, okay, the interest expense is actually 600,000. Okay, so that means 1 month is 100,000. So if I were to declare the interest expense for 2 months, actually the amount is actually 200,000 here. Okay, 200,000 here, and the balance of it is here, 400,000. So when will this two item will be paid? Okay, it will be paid here on the 30th of April. Okay, that means you will be paying for this 400,000, which is the interest expense for January until April, and you will also be paying the big backdated interest expense, which is 2 months. That is for the month of November until December. So this is actually your interest payable. So that is why during the redemption, okay, that is towards the end, you have two payments of interest that is separated. Okay, this one is for the current year, that is from 1st of January until 30th of April, and this one here, this 200,000, is for the previous year, that is from 1st of November until 31st of December. Actually, both are the 6 months interest. Okay, but they are separated because this 200,000 belongs to last year's interest expense, and this 400,000 belongs to the current year interest expense. So that is why you see the payment of the interest is separated into two. One is in the form of interest expense, and the other one is in the form of interest payable, because the interest expense was already declared during the closing of the date, that is on the 31st of December 2021. Okay, so this is how you go about with the redemption of the bond. Okay, so now we look at how we present our liabilities in the financial position. So this is very easy actually. So as usual, you will separate your liabilities into non-current liabilities and your current liabilities. So your non-current liabilities will be on top. Okay, so you list down all your non-current liabilities, and then you will total up the amount, and then we'll add up with our current liabilities, and then we will total up everything. Okay, so that brings you to the okay, so here is your non-current liabilities, and then you have your current liabilities. So both the non-current liabilities and current liabilities will represent the total liabilities in your financial position. Okay, so that's all for chapter 10.